Hi. Uh, in this video, we are explaining about the public debt issue and also how to look at the current public debt issues of IIFL Home Finance and Piramal Capital and Housing Finance Limited. So before we go into the public debt issues of these two issuers, let's go to see what is a public debt issue and why do they call it a public debt issue. So a public debt issue is something like an equity IPO. Only thing, when it's an equity IPO, the issue is for equity shares of the company. The public debt issue is issue for the debt of the company, issued through in the form of bonds. The process for floating a public debt issue is similar to that of an equity IPO. You would need to have a prospectus submitted to SEBI who will vet the issue. And then you have to have arrangers who will then do all the work in terms of showing the issues, talking about the issues to investors. And then you get to invest in this issue. The difference between a public debt issue and what is called a private placement of bonds is in a public debt issue, your investments is as low as rupees 10,000. The face value of the bond is only rupees 1,000 and the minimum investment is 10,000. In a private placement, the face value itself is rupees 10 lakhs and minimum investment is also rupees 10 lakhs. So that's the big difference. The second is the public debt issue is also traded on the BSE and NSE. So if you do want to buy or sell the bonds you're invested in a public debt issue, you can actually go to your broker, online brokerage account, and then put the orders for buying or selling the bond like you do for any equity shares. So the best thing about a public debt issue is the ease of transaction for an investor and also the fact that it is listed and offers liquidity through the stock exchanges. Now coming to the individual public debt issues. So let's start with Piramal Capital and Housing Finance Limited. So the details are given here. I'm not going to talk too much about the details. INR bonds will give you all the details if you log into inrbonds.com, or you must have received all the details through various other houses that are actually promoting this public debt issue. Now, let me be clear. We are not in any way promoting this issue. And we don't gain anything out of you investing in this issue. It's just for us to make sure that you invest in the issue with the right knowledge and the right information, which you may not find elsewhere in any other forum who are marketing these issues. So what are the three main considerations in a company if it's a bond? So when it's a bond, what is the biggest risk you face? The biggest risk you face is the risk that the bond issuer will not be able to service your investment. That is, they promise a coupon rate, and in this case, it's anywhere between 8.39% for retail investors, going upwards, and they are not able to repay your principal. So you have to be very sure that you understand the fundamentals of the company, and that the company is going to be well placed to service the bond, because each bond matures starting in this particular issue. The bond maturity starts in 26 months, which is just 2 years and 2 months, and goes up to 5 years, right? 60 months, I think. Or even some of the issues like IIFL Home Finance goes up to more than 5 years, 87 months. So you have to be very sure that this company can service your capital for all the while paying you regular interest and also paying you the principal when it comes up for maturity. So that is the first consideration you must have. So what you need to do is look at the credit profile of the company. Now the credit profile of the company, you can get it online. You can go to Google and get it from the rating agencies, or you can come to INR Bonds, where not only we give you the details of the issuer, but we also have our own proprietary credit risk score, which is actually does not depend on what is the rating of the bond. Now we know what all happened to IL and FS is a issuer that was rated AAA and has did and defaulted in 2018. So a lot of investors thought AAA, it was AAA and rating and it carried high safety, but it also and the fact is it defaulted and didn't pay their money back. Similarly, there was a bond issuer called DHFL who defaulted in a similar fashion. They were also rated AAA. So you have to understand what is the credit profile of the bond, what is the financials of the bond, similar to how you would look for it when you're investing in an equity, right? And in this case, it gets even more important because your capital can be stuck and liquidity, you will not be able to sell the bond. Whereas in equity, you can sell the shares at whatever price you can, right? Now, so obviously, when we are talking about Piramal Capital and Housing Finance, INR Bonds has given all the details, including credit report and issuer report, just to understand what the issuer is doing, what are the positives for the issuer, what are the negatives for the issuer. And also, you can look at the credit spread score, and then you can take a call. So the credit spread score gives you something, whether it's a low risk investments, medium risk investment, or a high risk investment. So the first thing you need to consider is the credit profile of the issuer. The second you need to consider is the interest rate, whether interest rates, overall interest rates, whether they're going to go up or down. Now that's something very difficult for you to understand. Why should interest rates go up or down? But all of you know that currently interest rates are very low. Your fixed deposits is giving you nothing. So all of you are looking to invest in bonds like Piramal Capital and Housing Finance because the yields given are pretty high. And since Piramal Capital offers a bond which is 2 years in maturity, they also offer a bond which is 5 year in maturity. And then IIFL Home Finance offers a bond that is about 87 months, which is almost 7 years in maturity, right? So the main thing you need to understand here is if the interest rates are low, then from here, can it go down further or will it go up? So if you think it can go up, then you're better off investing in the short term paper, short maturity paper, which is 2 years and other. And if you think they're going to be stable, then you can be looking to invest in longer maturity. If you think they're going down also, you can look to invest in longer maturity paper bonds, which is 5 years and above, right? But if you think they're going to go up, then obviously you have to invest in the shorter maturity bond. And that's largely because one is after 2 years, you can actually reinvest your funds at higher level, higher returns, higher coupon bearing bonds because interest rates would have gone up then. And the second is if you want to sell during the meanwhile, then you may not suffer a capital erosion. That is, you may not have to sell at a lower price than what you have invested in. So typically what happens is the way it goes is this. If you invest in a bond which is which has a coupon of 8.4% and face value of 100 rupees, and if if the yield actually what we call yield to maturity goes up because of rise in interest rates, say in next year, the same bond is offered at 8.8%, then the face value of the bond, the price at which you sell the bond, will be below rupees 100. So you will have a capital loss on the principal. Whereas if in the same breath, if interest rates goes down and next year if the bond is issued at similar maturity bond of the same issuer and credit profile is issued at 8%, then you'll be able to sell the bond at a higher price that is over rupees 100 face value and you make a capital gain. So you will have to have a view on whether interest rates are going up or down just to take a call on which maturity you have to of the bond you have to invest in. Right? INR bonds again is a forefront in providing the details of where interest rates can go, because we do a whole host of research on macroeconomic factors, environment, RBI policies, union budget, inflation, etc., which gives you a very decent indicator of where interest rates will go next year. The third factor is obviously liquidity. Now, you may not need liquidity. You invest in the bond with a view that you want to sell by holding it to mature. You want to hold it to maturity of the bond because you want continuous coupon flows, right? But sometimes you may need to liquidate because of various factors. Each individual has their own factors for which they might want to create liquidity or liquidated bonds. Then you'll have to see how you can sell the bonds. So a public debt issue, or since all these bonds are listed on the stock exchange, they're much more liquid than what you would call a private placement bonds. But having said that, many of the bonds that were issued much earlier, say in 2018-19, many of the bonds still do not trade because of various factors, even in the stock exchanges. So you'll have to be very sure about whether these bonds can continuously trade. And that is a factor of how good the issuer is and how good the um, and how good the um, how good the issuer is and how good their financials are, so that they can continue to keep a very good track record and have a very good uh, opinion of the investors. So any investor who wants to buy the bond, even in the secondary market, will look to buy the bond, and that gives you the opportunity to sell it to them, and that gives you the liquidity in the market for your bonds. Right? These are the three main factors. So now you have two public debt issues that are being offered for investments simultaneously. One is IIFL Capital and Home Finance. One is Piramal Capital and Home Finance, and the second is IIFL Home Finance. As I said, the details are given in this video here. And if you do want to apply to any of these issues based on what I have told you in your if you've got enough informed opinion on investments now, then all you need to do is just go to click on INR bonds and take a free trial if you're not a member already, and you'll get all the details as well as details of subscribing to the public debt issues. Thank you very much, and happy investing in bonds.